Welcome to the Philippines, a rising tiger economy with a young and vibrant population reaching the 3,000 US dollar GDP per capita tipping point where demand will boost for higher value goods such as durables. And the best way to capture this growth is by investing in Concepcion Industrial Corporation, the leading supplier and manufacturer of air conditioners and refrigerators in the Philippines. We're from the Ateneo de Manila, and we issue a strong buy recommendation for CIC because of 3 points. 1, market leadership with a proven track record. 2, a strong growth potential in an under-penetrated market. And 3, aggressive expansion backed by solid financials. All happening to an undervalued stock. We use the sum of parts evaluation method and DCF analysis to find out that from 41 pesos, CIC has a 23% upside, coming up with a target price of 50.49 pesos. But first, who is CIC? CIC is the holding company that primarily operates through its core businesses, namely Concepcion Carrier Air Conditioning Company and Concepcion Durables Incorporated, selling air conditioners and refrigerators respectively. CCAC is a joint venture with United Technologies, the company behind the Carrier brand, while CDI is wholly owned. Revenues are broken down to 65% aircon, 28% refrigerators, and 7% for its growth platforms because CIC is now expanding into people-moving equipment and other consumer appliances through Concepcion Otis and Midea. Versus the competition, CIC has the widest product portfolio range with its leading and trusted brands.
For the first point, market leadership with proven track record. With 50 years of operational history here in the Philippines, CIC has gained strong local knowledge, and this has enabled the company to hold the #1 spot with market shares of 25% for the refrigeration market and 37% for the air conditioning market. CIC maintains its market leadership through its multi-branding strategy, with its leading and trusted brands specifically targeting different market segments. We have Carrier and Toshiba for high-end, Kundura and Kelvinator for mid-tier, and now Midea for entry-level. This is further supported by CIC's solid market presence, as evidenced by its wide-scale distribution network, placing its products in 90% of all appliance stores nationwide. Second, its extensive after-sales support, the largest in the Philippines with over 300 installer and service centers. Third, key relationship with 7 out of the top 10 Tier 1 real estate developers, covering 60% of the Philippine real estate industry. With CIC's strong R&D and a Philippine-based manufacturing facility, it has the ability to custom-fit air conditioner and refrigerator designs for these real estate developers, providing them with turnkey solutions. Lastly, with CIC size, it has reached a dominant operational efficiency with only 17% OPEX to sales ratio, the lowest among its competitors.
Now that we have established that CIC is the market leader, let's take a look at the second point. CIC has strong growth potential in an under-penetrated market. The Philippines has experienced unprecedented economic growth over the years, in fact, one of the fastest in Asia. Its growth is currently on an uptrend, as indicated by the higher 3-year CAGR of 7% compared to the 10-year CAGR of just 5.2%. We expect this to continue in the future because of 2 main reasons: the rising construction and increasing consumer spending. With the first point, construction is expected to rise in the Philippines much faster compared to its Asian counterparts. This is due to the capital investments in the country and the rapidly expanding BPO sector. For the second point, the consumer spending is expected to increase as the Philippines enters the demographic sweet spot, resulting to a growing working population. Like what the other countries such as China and Indonesia experienced, the demographic sweet spot will increase the household disposable income by a CAGR more than double that of the forecasted inflation rate for the next couple of years. Now, even if these 2 factors already increase the demand for CIC's products, CIC can further magnify its growth because it is operating in an under-penetrated market, with penetration rates of 6% for air conditioning and 35% for refrigeration, one of the lowest in the ASEAN region. Because of this, we expect CCAC to grow its sales by CAGR of 9.8% and CDI by 10.2%.
We now know that CIC is the market leader in an industry with a promising growth potential. But how will it take advantage of this? CIC has an aggressive expansion strategy while backed by solid financials. CIC positions itself to be the leading end-to-end solutions provider for both the consumer and business segments. Its recent JV with Midea and acquisition of Otis are actually steps towards this goal. Midea expands CIC's reach in the consumer appliance market from 55% to 100% of the 60 billion peso market, while Otis allows CIC to provide people-moving equipment for its building and industrial solutions, tapping into this 13 billion peso market. To complement this further, CIC is eyeing an expansion into security systems, lighting fixtures, and fire safety. However, is CIC financially capable of pursuing this? Yes, it has the financial flexibility to fund its growth strategy with internally generated funds and new debt. How? Let's take a look at its financials. CIC is capable of generating strong cash flows, with free cash flows growing at a CAGR of 16% from 2014 to 2020. This is supported by CIC's rising sales, doubling its 2014 sales to 16 billion pesos in 5 years. This is further supported by CIC's expanding margins through its aggressive cost reduction measures that lead to EBITDA margins of almost double that of the peer median. To add to this, CIC is capable of acquiring new debt at a low marginal cost of capital. This is due to its under-leveraged capital structure with a debt-to-equity ratio of only 26.2% in 2014, considerably lower than the peer median. Both of these factors provide the necessary capital for CIC to pursue its expansion strategy. With high levels of cash and little to no debt, you might think that CIC is being inefficient. But when you take a closer look, CIC is actually building a war chest, preparing itself to pounce at the next investment opportunity that comes along.
Yeah, that sounds like a great story. But I think let's let the numbers speak for themselves. We used these valuation methods, and upon analysis, we found out they all point to one thing. CIC is undervalued. Using the sum of parts valuation method and DCF analysis, we arrive at our intrinsic price of 50.49 pesos. But how exactly did we arrive at this value? Using a moving WACC of 9.5 to 9.6%, CCAC's cash flows are able to contribute 35.73 pesos. Meanwhile, we use a constant WACC of 10.4% for both CDI, giving us a value of 11.42 pesos, and for the growth platforms, giving us 3.34 pesos. Summing all four subsidiaries gives us 50.49 pesos. Now, this analysis is actually supported by CIC's strong EPS growth rate of 12% and its high ROE of 25%, which is double from that of the peer median. Now, for our second method, we have conducted a relative valuation analysis, and we found out that CIC is trading at a discount compared to its peers. Its PE ratio and its EV to EBITDA multiples are significantly lower than the peer median. This indicates that CIC has a huge upside potential. Lastly, we did valuation comparison analysis. Across all 2015 estimates, CIC's target price is above 41 pesos. This indicates robustness in our previous two analyses and supports our recommendation. Now, with a target price of 50.49 pesos, CIC, like any other businesses, has inherent risks. But for today, we'll be focusing on three critical risks, namely increasing competition, commodity price risk, and execution risk. First, CIC's sales is in danger with the increasing competition in the market. But with CIC's strong local knowledge with 50 years of operational history, solid research and development, and commitment to cost efficiency, CIC has everything under control. Second, CIC's operations are highly dependent on raw material importations. And historically, these commodities fluctuate between plus minus 200 basis points. But relax, CIC invests in hedging instruments and locks in prices with its suppliers. Just to make sure, we have conducted a sensitivity analysis, and even an increase of 200 basis points on top of World Bank's forecast, CIC's target price will still be 49 pesos, 19% upside. Still a buy recommendation. Lastly, with CIC's recent ventures with Otis and Midea, there are lots of uncertainties. But as we can see, even without the growth platforms, CIC's target price will still be 47.15 pesos. 15% upside, further strengthening our buy recommendation.
Let's have a recap. We now know these 3 points: market leadership, strong growth potential, and aggressive expansion. With a target price of 50.49 pesos, CIC is your one-way ticket to the Philippine growth story. Thank you for listening.